Welcome back to Happy Investors, this time with a small update about a newly purchased stock from America. It's been a while since I closed many positions from America, and I'm gradually starting to re-enter the American market. Not so much because I believe everything will turn out well, but more because I look at individual cases. Can I buy a high-quality stock for the long term? And I might want to expand this new position to 5%, which is quite a lot. This means that I have quite a lot of confidence in it for the very long term. In a moment, I'll show you how it stands, why I bought it, and also the characteristics of the company. My name is Jorik Vermeulen, investor on behalf of Happy Investors. Welcome back to watching the videos. It's always appreciated that you watch, and I hope to provide you with value. Please note, we never give personal advice purely for inspiration, and in the short term, it can also disappoint. For example, I logged into my DeGiro account today. A quick check, and I see that one of my largest positions, Evolution, is suddenly at 17%. So if one of your largest positions is at 17%, it's naturally not a pleasant experience in the very short term. Meanwhile, Stalco AB also had a bad day this week with a total drop of about 20% in just one day based on, of course, quarterly figures. Yes, in the short term, things can naturally be a bit disappointing, but the goal is, of course, to buy long-term compounders that have their business model well in order with a small or large competitive advantage. And in that, I try to buy companies that can only win in the long term, but there is never a guarantee of success. Evolution, one of my largest positions, I have shared in previous videos, I can go up to a maximum of 10% for one stock. That is really the maximum I want to invest. And I still had a little bit of ammunition left for Evolution, if you can see it that way. And I just spent it today on this big drop of 17%. As a result, the total loss stands at 20%. Soon there will be a dividend of about 4%, which is not insignificant on such an amount. And so I bought Evolution, as you can see, today at this video snapshot at a price level of $63. That's about Evolution. I can't do anything more about it, unfortunately. I believe in the long-term potential of this company. And look at the intrinsic value. But the company has been in bad news for more than a year and a half actually. And then also mitigating measures like cybersecurity, plus actually measures to prevent illegal markets, which is a good decision for management. But in the short term, that naturally hurts. So then you get these kinds of situations. I'm actually not worried about it. Then the new position bought from America, as previously shared. I do all my USA purchases through Maxim. For that, a new account was set up. That is much cheaper than with DeGiro. That saves a lot on currency costs. No matter how you look at it, that just saves a lot of money, especially with large amounts. And in this portfolio, which I had a while ago, I only had a SEF. So a closed-end fund for BlackRock Science and Technology with the ticker BST. I've had that for a very long time. And recently I bought my first actual new position in Kinsale Capital. Let's take a look at that. The purchase was approximately $10,500, which is about 3%. And we see that the unrealized gain is actually 0.6%. It dropped slightly after I bought it and rose slightly again yesterday. I will delve deeper into what this company does, how they are performing, and why the stock might be interesting for long-term investing. Now, the company Kinsale Capital has the ticker KNSL. At the moment, the price is around 34, and what the company does is actually specialize in the insurance world, focusing on excess and surplus lines. And it mainly involves property and casualty, but they also engage in some other forms of sport. From Morningstar, we actually receive a positive rating. They give a 5-star rating with a small economic moat. I think that this economic moat will only become larger and larger over time. This means that a competitive advantage only increases based on scale, especially because the business model is realized on low cost. And of course, in a world like insurance, it is crucial to be a low-cost supplier. That is, of course, how you create added value in the long term. The fair value estimate from Morningstar is slightly higher than the current price, about plus 20%, with a total of 9 IHA analysts indicating that it is good, and 3 indicating that it is a buy. Because the short-term situation might be less interesting, but I am buying this company purely based on very interesting prospects. At least that is my assumption, and I will show you why. First, a bit more about the company Kinsale Capital. You can view the latest investor presentations on their website, or we will go through them more quickly. But in any case, they are focused on the small account access and surplus lines. And they are trying, in this quite challenging specialist niche, to create a monopoly position. And as you know, in the laws of business, creating a monopoly position is always super interesting. Currently, they only have a very small share in the market, 1.4%, still leaves plenty of room for growth. And there are a number of other matters. The only thing I don't quite understand is that they claim to have proprietary technology. They won't easily disclose that, of course. I have researched this company for more than a year, not full-time, of course, but just followed it occasionally. Then I delved a bit here and there into the market position, and the only thing I don't quite understand is, well, what exactly is this proprietary technology? But, well, maybe we'll learn that over time. That's a disadvantage, right? I invest. Why? Because I believe in the management. And I find this very important. If you don't understand everything, you shouldn't invest in principle. Invest only in something you fully understand. Well, let's say I understand this 90%, and yet I do it because I trust the management. That is crucial to making a long-term decision. And management, in this case, is still the founder. And, Michael, no idea what kind of person he is. However, we can see that the entire management has over 30 years of experience, except for two people here. And what I find more interesting is that the founder is still at the helm. He naturally also has the right incentives for long-term growth, as does the COO. Brian has been employed since, I think, the founding of Kinsale, namely since 2009, approximately. Well, there are some other management members, experienced, knowledgeable, it seems to you. Interestingly, the book value has increased. The market cap has now decreased somewhat after a recent drop, and is now around 10 billion. So still relatively small enough to be able to grow in the long term. If we look at the performance versus the S&P 500, looking back at the past is no guarantee of future success. Only very important is that you can always clearly see how each can look back 10 years or 5 years. What are the performance, the results? Because often it is the case that the winners keep winning and can maintain the same performance to a lesser extent. It simply means that if the performance is very high, and even if it will be slightly lower in the future, it is still high. That is very important, and we will soon see that reflected in various data tools. Actually, this stock is simply performing very strongly. So the compound annual gain since the IPO is an astonishing 50% return per year. Another source I have indicates a compounded growth of about 36%. So there is a nuanced difference, however. This performance is from February 2024, and of course we are now a bit further along. So they focus on a small niche market, although it might not be a niche market anymore. There are some other matters mentioned here. They also indicate how they differentiate but as I mentioned, a low-cost business model is crucial. But also, they are simply 100% focused on it at the moment, and they are just getting better and better at it. This market is quite large, about 115 in market value, according to 2023, according to this company. And yes, this company only has a very small position in terms of market share. There are some other matters mentioned here. Here you also see the distribution across various sectors. So the product portfolio is actually very important, especially, for example, what we see. The book value per share has increased enormously, especially in percentages. The same goes for the diluted earnings per share, which is increasing. They have an investment portfolio of 4 billion. In other words, 1 billion and 4 billion based on a market value of 10 billion is certainly not insignificant, so that adds to it. Also important is the return on equity. In this case, the operating return on equity is particularly high, and we will see that again shortly. If we look at the price tag, that is actually the only doubt. For a long time, the price to earnings ratio has averaged around 35. And after a recent decline based on the quarterly figures, the price to earnings ratio has dropped to about 26. It is not very common for the price to earnings ratio to be around 25. I was able to buy at a price to earnings ratio of 24. And that is indeed a price tag on the higher side. You only want to do that if you believe in the long-term growth conditions. And if we then look at what the potential return could be, the EPS growth expectation from various analysts and data sources is on average about 15% per year. I can agree with that, considering all the historical factors, the business model, and the increasing competitive advantage they are achieving. And it's a kind of snowball effect because all the cash they generate is reinvested into the portfolio. And that's a snowball that keeps growing, keeps growing, keeps growing, and gradually achieves higher returns on equities. In other words, return on capital. And if they, as management, can continue to do that, then they want to achieve a high return, much higher than other types of companies that perform less well. The price to earnings ratio at the moment has slightly decreased to about 26. If you were to maintain the normal multiple of the past 10 years, which is, for example, almost 35, it means that you could still achieve an average return of 25% per year over 3 years. I personally think that's a bit on the high side. I find 26 already a bit on the high side. Well, if we assume, for example, 24 as an example, then the average return is about 9 to 10% per year, and I think this might be more realistic for the short term. However, the downside could be if the EPS is realized, the figures we see below, and the price to earnings ratio drops for whatever reason, resulting in a negative return over the next 3 years. I personally think that they can achieve a higher return so this case is based on that. I myself assume a price to earnings ratio of around 25, so about a 10% return per year, where I think it could turn out better and thus have a positive output for the long term, possibly 15% per year. But that is, of course, an assumption based on intrinsic value calculations from market share. Brief update, the investor stars are at 4.5%. That is quite high. What I want to show is actually the development of the net income margin. That is this green line we see here. And the yellow line is the EBIT margin. And you see that it increases slowly. Often that is, of course, a very good sign when it increases. As I said, the valuation, yes, the price tags are somewhat higher. The future price earnings is estimated at 24. Well, that is significantly higher than the sector median. And I think this is a very important point. Why would we invest in this company while there might be other companies in the same sector that either have a stronger earnings model with a lower price tag or the same price tag? Or number two, they might be less strong, but perhaps relatively very cheap. So in the short term, doing good business. So then you actually get a kind of short-term momentum investment in the same sector. And with that, you can potentially achieve a much higher return. But my reason for investing in companies is purely long-term and long-term. I stand for 5 to preferably 10 or 20 sunt years. And then I think if you approach it with that mindset, this company is very interesting in terms of growth potential, especially because they are currently managing their cash very smartly. At least that's how it seems. The price tags are on the higher side at the moment, but the price to earnings ratio is not entirely accurate. As often, the price to earnings is a shortcut. I also need to look at, for example, the PEG ratio. That is above 1. That is not positive, but 1.6 is not extremely high. But more importantly, we also need to look at a bit of accounting and cash flow analysis and such matters. And then you will also see that, for example, the balance sheet shows cash of 180 million. They have virtually no debt, but we have seen that the investment portfolio now totals more than 4 billion. So that is something that is not included in these figures. So also look at, for example, the book value. Are we looking at growth over the past 5 years? On average, revenue growth was an impressive 30% for the coming years. If it is already 15%, that seems possible to me. Then it is actually already quite good. But of course, things can always disappoint, especially in the short term. EPS growth is estimated at about 15% for the next 3 to 5 years. And if we look at the compound and you want growth rates, yes, they are also quite high over 10 years, actually super high. So everything looks good from a growth perspective. And if you compare that to the price tag, then it just seems interesting. This is, for example, much better than certain other high quality stocks like, let's say, TSM or ASML. Or, for instance, Nvidia has also performed very well, but the future might be a bit less promising. So I always try to compare that with other potential investments. I personally don't have any positions in insurance, so this is my first and probably also my last position in this world for the long term. Looking at the income markets, they have risen, as we have seen, but the 5-year average is still quite high. It might decrease, but more importantly, we see here, for example, that the return on equity is actually consistently relatively high. Return on total capital is only increasing and is also high. So apparently management is doing good business here. It's crucial to also look at the cash flow. We see a steady line of increasing profits, and we see that things like spark plugs and such are all relatively minimal. The capex investments are also relatively very low. This means it is an asset-light business model, and that is one of the criteria I personally use for investing. It must be an asset-light business model. That's simply how you achieve the best results for the long term. And you can see here in this line below that net cash from investing is almost everything they generate from cash flow from operations. So they reinvest everything back into their operation, and as a result, that snowball gets bigger and bigger. And I hope they can maintain this in terms of return on equity and the profitability of the business model. Finally, we also see a bit about the repurchase of their own shares. Not much, but they are buying back a little here and there, and they pay out a small amount of dividends. But it is not a dividend stock at the moment. Finally, in the very short term, Zach Schrenk indicates a hold. This is in line with the factor analysis, which also indicates a hold. The price target is indeed for the next 6 to 12 months, in line with that of Morningstar, around $520. The reason I bought now after waiting a long time is because based on the quarterly figures, the price had dropped again. It had dropped to about 420. I bought around this price level, and we actually see a kind of support level around the price of 410. We see that here on the screen. 410, and actually every quarterly report, the stock had dropped significantly in the short term, about 7% in one day this week. It might drop a little further, maybe to a new support level, which is still about 11% down, or maybe even further to 20%, where there is also a support level at the price level of the end of 2023. If that happens, I can buy a little more. My total position is now about 3%, so I can buy a bit more to reach the maximum of 5%. This way, I keep some buffer on hand in case it drops further in the short term. Still, considering the overall fundamental valuation combined with the long-term growth, I do think this company is indeed interesting to invest in. And in doing so, I mainly look at the quality, in other words, the profitability that is starting to increase, and we see higher figures in return on equity and return on capital. And this is often a result of an apparently very profitable strategy with a company where the founder is still at the helm. So they have long-term incentives, and I hope this snowball continues to grow given the small market share of 1.4% that we have, that they can still grow in the long term. Well, the current market value is about $10 billion at the moment, and it could be that if they achieve a 15% return on average per year, they will double every 5 years. So in 10 years, you could have your investment back, but waiting 10 years might be a bit much for some people. So if you don't have that patience, this company might not be the best investment for you. Do you have that patience? Then you might enjoy this beautiful snowball effect. Thanks for watching. Let me know what you think of this stock, and I would say see you in the next update.